What's up guys, Jay Graff back at it again with another investing video. As you can see, we're already in my Robinhood app. I have a lot that I want to talk about today, so I went ahead and skipped the intro and figured we would jump right into my Robinhood portfolio. So it has been pretty crazy these last couple weeks. The market has been all over the place, mostly down. And in this video, I'm going to share with you all what I've been doing. And I've actually done quite a bit. So if you all look at my stocks, my portfolio looks vastly different than it looked 2 weeks ago. 2 weeks ago, I probably had shares of about 25 different companies. I had probably close to $7,500 invested. And as you can see, I have most of my portfolio in cash right now. All I own right now are 9.6 shares of Waste Management. So what I did with Waste Management is not too long ago, about a week and a half ago, I decided to actually sell my shares of everything. Now this isn't something I would necessarily recommend doing, but I personally felt like the market was going to continue to drop further and further, and we had a big jump one day and I thought it was a good time to get out. So I went ahead and got out. Here pretty soon I'll show you all what my returns all time look like, and maybe that'll help me explain a little better why I did what I did. So like I said, I have some Waste Management. I have 9.6 shares. So what I did with Waste Management is I used to have 8 shares, and I sold when the price was at about $109. And since Waste Management is a company that I really do like, I went ahead and picked up some more shares today. So as you can see here, I sold $872.47 worth of Waste Management. And then I decided to take advantage of Robinhood's fractional shares investing. So I just took that money that I received when I sold my shares and I bought back as many shares as I could with that same amount of money. And I ended up buying 9.6 shares. So I didn't really make any money, but I did increase the number of shares I'm holding of Waste Management, so I'm pretty happy with that. The other stocks that I decided to buy, I did a very similar thing with Procter & Gamble. Back like a week and a half ago, I sold my one share for $116.36. So today I went ahead and spent the same amount of money and picked up 1.14 shares. So once again, got a little bit more Procter & Gamble. Did exact same thing with Coca-Cola. And then Kraft Heinz is actually a new stock that I picked up. I picked up 5 shares today, and the reason I did that is because Kraft has been, it went down pretty considerably the past 3 months, but I'm also reading good news, like, you know, Kraft Heinz is having to talk to Amazon and Walmart about speeding up their deliveries, I guess because they have such a high demand. And then this article here is talking about how the Kraft Heinz factories have moved to having to work 3 shifts per day in order to keep up with the demand. So Kraft Heinz is a company that makes food products. I think they are set up to do pretty well during a recession. They do have positive earnings, which is a big plus for me. They have struggled in the past couple of years, but I know Warren Buffett is a pretty big holder of Kraft Heinz shares. I think he actually bought them when they were kind of higher up here, maybe around $30. I mean, it might have even been $60. But anyways, I like Kraft Heinz. I think they'll do well even if the economy continues to do poorly. And that's really why I decided to go ahead and buy all of these shares. Is I think all of these companies have at least some level of protection if the economy continues to go downhill. So I thought now might be a good time to pick up some shares. So I have not bought back my shares of a lot of different stocks and ETFs, including the Standard & Poor's 500 ETF. As you can see, it has dropped off a cliff. It was at almost 340 at one point, and now we are all the way down to $243. We do have a little bit of a jump back up over the past couple days as the Fed has talked about their new stimulus package. We'll see what that does. I'm not overly optimistic about how this will do in the short term. Long term, I do think Standard & Poor's 500 is going to do fine. The Standard & Poor's 500 has averaged a yearly return of I believe 7 to 10% since its inception. So conventional wisdom would say if you just held on to it for long enough, you would probably recoup your losses. I have always thought of myself as a buy and hold investor. I'm not really too sure what made me to decide to sell my shares. But after I sold my shares, the market continued to go down about 10 more percent. So I can't be too upset with my decision. I just personally felt that there was no way that the market would jump back up, and I just thought it would continue to fall for a while, which is why I did what I did. So this past trading day, I am up about 0.2%. Keep in mind that a very small percentage of my portfolio is now actually invested. I have cash sitting on the sidelines. I'm looking for deals right now, looking for companies that I think will do well, looking for companies that are undervalued. And the thing that kind of scares me about all this is we've definitely had recessions before. We've definitely had, significant things that have impacted our economy, but there really hasn't been anything quite like the coronavirus. We have restaurants that are completely shutting down. Some are just doing takeout or delivery. Movie theaters are shutting down. I saw an article about the AMC CEO who came on the news and literally said that they were making zero revenue, which is pretty crazy. I mean, you usually think about something like a movie theater company, and of course they tend to do poorly during a recession or during harder economic times, but it's almost completely foreign to think about them having no revenue whatsoever. So I just think things are very, very weird, very strange, very new right now. And I wanted to get out of the market for the time being and kind of rethink my game plan. That was just my personal decision. I'm not recommending any of you all do the same thing. In fact, I'm not going to offer any sort of advice to you all right now. I'm still trying to wrap my head around what's going on. That being said, I do personally think that we will have a recovery, and I think over the next 5 to 10 years, you will likely see returns similar to what you'd seen if you invested during the financial crisis in 2008. That's just my personal opinion. History has kind of shown that is what tends to happen, but of course, there's no guarantee. So like I said, this past trading day, I'm up 0.2%. Over this past week, I'm down 1%. This past month, I'm down 23.5%. This past 3 months, I am down 22.8%. This past year, I'm now 14%. And all time, I have lost about $700, which is 8.5% drop. So am I happy that I lost this money? Of course not. I am happy that I sold out when I did. When I started this, I knew it was going to be a learning experience. I knew that there was the potential for me to lose money. I'm not overly upset about this. I'm young. I have time to make this money back to recoup these losses. I am going to continue to invest. Probably just continue to buy shares of companies that I love when I feel like they are undervalued. I think there will be increasing opportunities to do that. Now, there has been some good news. I heard Apple was thinking that they could open up at least some of their stores in the middle of April, I believe. As you all probably know, they closed all of their retail stores around the globe, and they're thinking that hopefully they can open them up soon. What else? I don't have a whole lot else to talk about here on the Robinhood app. We will go into my M1 Finance portfolio here in a second. About the only thing that I will talk about is in times like this, usually companies with a high amount of cash tend to do pretty well. So stocks like Google, their shares have been hit, but not as bad as some of these companies that have a lot of debt. As you can see, Google's down about 16% over the past 3 months, down 20% in the past month, but that is nothing compared to a stock like Boeing that has dropped 60% in the past 3 months and 58% in the past month. So a big topic of discussion lately has been stock buybacks. So over the past couple years, a lot of these large corporations, in an attempt to enhance their shareholder return, they bought back shares of their stock. And what that does is it means that there's less outstanding shares. So investors effectively own a larger portion of the company, which increases the value of those shares that are outstanding. And due to everything that's gone on lately, people have started to question that as a corporate strategy. Boeing has come under a lot of fire because they dumped a lot of their cash into stock buybacks, and as a result of that, they did not have enough cash to survive something like this and had to ask the government for a bailout. Now, Boeing probably will get this bailout, and Boeing probably will survive, but I just wanted to share with you all that little piece of information. So one stock that I have been kind of interested in is A.O. Smith. So A.O. Smith, they manufacture like water heaters and air purification products. And the reason I like A.O. Smith is because they have a very low debt to equity ratio. So that's just a measure of how much debt the company has. So A.O. Smith has very low debt. They are also a dividend aristocrat, meaning that they have increased their dividend payment for at least 25 years in a row, every single year. They have dropped considerably, but I think because they have such low debt that they will be able to withstand these tough times, and I will probably be looking to pick up some shares myself here pretty soon. Now, keep in mind that just because I like a stock does not mean you should go out and do it. You definitely need to do your own research, especially in times like these. With all the volatility in the market right now, you could buy a stock tomorrow at 9 o'clock, and by 4 o'clock it could be down 10 or 20%. It's just pretty crazy times. So with that, we'll go ahead and jump into my M1 Finance portfolio. So here we are in my M1 Finance portfolio, and for those of you all who don't know, this portfolio is solely based on dividend stocks and hopefully increasing the dividend payments I receive from these stocks over time. I've been trying to invest money on a pretty regular basis. I've kind of stopped doing that as much ever since the fears surrounding the coronavirus have started. But I plan to continue to fund this portfolio here in the future once things settle down a little bit more. So looking at how this portfolio has done, this past trading day actually was pretty good. I was up almost 10%. Over the past week, I'm still down 8.1%. This past month, I'm down almost 31%. This past quarter, I'm down about 35.4%. And all time, which is going to be the same return as this past year since I started this portfolio in July of 2019, I am down 48.25%. So one thing that I noticed today and did a little research on is if you go over here and you look at how much money I've invested, it's about $1,500, and I have lost about $435 of that. They are Unrealized losses, because it's just the amount of money my shares have dropped in value. I haven't sold any shares, so I haven't realized that loss. So at a glance, you would think that my total gain, or rather total loss, would be a drop of like 33%, not 50%. So the way M1 Finance treats return is it is actually a money-weighted return, and I won't get into the specifics here, but essentially it takes into account not only how much you've invested, but also when you've invested that money. So in theory, I have about a 33% loss, but it reports it as a 48.25% loss. If you all want to do a little more research about how M1 Finance calculates their return, you can check it out. I'll leave their link in the description to their description on how they calculate this money-weighted return. It's actually pretty interesting, and I recommend you all check it out. So we'll go look at the dividends I received this past week. So I have received quite a few dividends. We'll start at March 16th. So I received 10 cents from Apple Hospitality, 11 cents from Consolidated Edison, 6 cents from Dover, 2 cents from Interplus, 8 cents from McDonald's, 5 cents from Stag, 7 cents from Stanley Black & Decker, 6 cents from Equinix, 9 cents from VF Corporation, 7 cents from Waste Management, 18 cents from Weyerhaeuser Company, and 7 cents from Lind PLC. So something I am a little concerned about for this portfolio is I think a lot of companies may have to cut their dividend payments, especially companies that have really been hit hard by the coronavirus. So that's something I am a little concerned about. We'll kind of have to see how things play out. I may have to remove some companies from my portfolio and add in some different ones. I'll kind of play that by ear. And of course, I'll keep you all updated if anything changes. So with that, I think I'll wrap up today's video. Thank you all for watching. If you enjoyed the video, please hit the like button. Please subscribe to the channel, and JGraph out.